Hello, viewers. Hello, listeners. I'm Gaspar.
And I'm Robert, and welcome to another episode of Casual, a show about technology and curiosity.
Yes, this is the third episode. Everybody knows what that means, right? We're pros. We have three episodes.
We're professionals, man.
Yeah. In the second episode, we talked about NUPL charts. We talked about Fear and Greed Index. And by the way, we introduced ourselves. This was a highly requested part of the episode. You guys reached out in comments and via Twitter, and some of you in person. Thank you for that. So we are taking in suggestions, we are taking in ideas. You can reach us in the comments or via email. So hi@casual.is, hi@casual.is. Send an email and we'll definitely respond. So for today's show, we're gonna do a quick overview of NUPL and Fear and Greed Index just to see what happened from the previous episode, and then we'll be diving into a difficult topic that's moving averages. Let's take it away with NUPL and Fear and Greed Index.
Yeah. So, yeah, last time we were checking this chart, the fear was at 18, and we were both kind of in shock. We were both surprised because we haven't checked the fear and greed index in a couple of days. Now we can see.
Speak for yourself. It was the first time for me that I saw an 18, and I was really shocked because so far, every time that I looked at the Fear and Greed Index, it was in 70s, 80s, 90s. So 18 was the first, and I was dropping my jaw to the floor. Just
And that's when we were checking out and seeing if it's on a 1 year scale where we were at. We were revisiting these previous all-time lows with the fear and greed index, and now we can see it's slowly picking up. So 2 days ago, it dropped down even to 16 while we were off for the
wow.
past 4 days. And now we're at 28, which
So
means
everything is picking up. Yay!
it means the market could be picking up. But we have historically seen this going sideways for a couple of weeks at a time, just jumping up and down. And let's jump off to our second indicator. So on a longer time scale, we don't see much difference. But if we zoom in to the past couple of months, we can see that ever since our last episode, number 2, we picked up and went up for over 2K. So we still haven't had the weekly price close. So we don't know what's happening here yet. But Gaspar, what do you think of this, of checking this chart out?
Well, first of all, for everybody who missed the previous episode, NUPL chart is basically a ratio between market cap and realized market cap. So market cap is all the money locked into crypto, and realized market cap is the amount of money moving around. Whenever that ratio gets closer to 1, it means that the amount of money moving around is getting larger and larger. That means that market is becoming unstable. And if that ratio goes down, that means that everybody's waiting for a change. And this is something that I see in this chart right now. So we are closer to 0.5. Everything's cooling down a bit. Well, it picked up from previous days, but still we are not in the blue zone over 0.7. So I guess everybody's kind of waiting what's going to happen next.
It's kind of funny and interesting to see like this how exactly we bounced on the 0.5 line. So previously when we broke it down, there was I don't know, a couple of months all the way from end of May all the way to August, there was kind of a bearish trend. Everything was in the yellow zone, which is optimism, anxiety, and now we were basically touched it, and now we're going basically barely above the belief and denial zone. So yeah, that's an interesting to see how that will pan out.
Okay,
So
we'll
now,
definitely check this out in the next episode just to see where are we going with this one. And for today, let's dive into moving averages. So moving average is a tool for defining support and resistance levels. And maybe the best idea is to clear just right up what support and resistance level is. For most of you guys, you could already be familiar with this, but we are aiming to provide stepping stones with this show. So stepping stones for further research, and for some people who are just entering now and are not familiar with this, let's go through the basics. So support and resistance levels are two levels where a price can either stop and bounce back or continue. And if we are talking about support, this is a price level where a downtrend can be expected to pause. So the price is getting lower and lower, and due to concentration of buying interest, so basically due to concentration of demand, price can either bounce back, meaning that market participants will see the value, start buying, and therefore start pushing the price higher, or it can just ignore that and continue to the next resistance level. And support level. And resistance is the other side of the coin. So as market is trending upwards, price action actually slows down and people are taking profits, price consolidates, and that's the level of resistance. And to identify those levels, we can use moving averages. So this is one of the indicators, and it's a constant changing line that basically smooths out the price that we have been seeing for the past few days, few months, whatever is the basis for us.
Yeah, and based on that, I think it's going to be easier, at least for those that have the computer in front of them, that will be able to see what the lines look like. But in basic, the most popular ones are, I don't know, 8, 15, 20, 21, 30, 50, 100, and 200. And an interesting note here is, like, those are the most popular ones, but some people use like 22 or, I don't know, 18 to have an edge before the masses, which use this as a main indicator. So that's like one of the interesting things, that some people just modify this moving day averages to give them an advantage.
Yeah, and we can choose any period of time for the basis. So if we take a longer period of time, we are flattening the curve of the price more, and if we are taking a shorter period of time, we are more closely resembling the actual price movements. So maybe the best would be to look at the chart and see what we have there. For everybody not looking at the video, so we have candles. By the way, we can discuss this. We have candles and we have moving averages, and in different colors we have, I think, 8, 21, and 50-day moving average. But before that, maybe candles. What are candles?
Candles. So right now our trading view is set to weekly candles. So these are the closing and opening prices for each week. So if we just dive a little bit deeper into the candles, the green candles have an opening price at the bottom and the closing price at the top, while the red candles have the opening price at the top and the closing price at the bottom. So both of these candles have kind of an extreme. So again, if this was some sort of price range between, I don't know, 50 and 60K, this top week could mean the price ranged also to 65K and the bottom to 45K, but it did not close at that price. And similar for the red candles, it's basically the same.
So we have set of 4 data points: the opening price, the closing price, and 2 extremes. And the time period can be anything you want. You can have candles for 2 hours, 4 minutes, 4 hours, 5 days, whatever you want.
Any time frame goes, especially if you're a short-term trader, you use probably smaller time frames if you're a long-term trader. And also different indicators can be used with different data time sets. So yeah, without further ado, as Gaspar already mentioned, we already have the simple moving averages set up on our screen, and the 8-day moving average is white, the 21-day is orange, and the 50-day is red.
And this is the great example how we are flattening the curve of the price. As you can see, the 50-day moving average is constantly in the upward trend for the past few months, and the 8-day moving average is kind of trailing along the candles.
Yeah. So as you already mentioned, the longer the period for the moving average is, the flatter the curve is. So this would be an example of a larger than a 50-day one.
Mm-hmm.
So yeah, let's take a look at what these moving averages can tell us. So Gaspar, you mentioned previously resistance and support levels. So
go ahead.
So in this case, we could see like the support levels for the 8-day moving average were basically broken down, and we also broke down to the 21-day moving average. and we kind of found support on the 50-day moving average. What would you have if you just had a look at this data set? What would your opinion be?
Okay, currently what I'm looking at is that we have, as mentioned, broken through 8 and 21 days, and it's reasonably to expect that something could happen with the 50. So at the current price point, we could either jump up or continue straight down. But it's reasonable to expect that with the 50-day moving average, so we are calculating the price over the 50 days, there's a lot of buying incentive around there. So it's reasonable to expect that a support level could be found around, what is it? It's a bit little on my screen, around 40, 47,
47 for
48,000.
the,
Yeah.
yeah.
So even though the price still continues to drop, it's reasonable to say that we'll hit at least pause at 47,000.
Yeah. And even,
but again, that's speculation. Anything could happen. This is not financial advice for everybody.
And educational purposes only. So this is interesting to see historically how these moving averages are really respected. And I understand why a lot of traders do a lot of their buying and selling sentiment on top of it. So we can, if we just check for the past couple of months, even like if we go back a full year, we can see that how much the price really followed the line of the eight day moving average. And even that, like the last line of support, the 50-day moving average also acted amazingly well. And maybe one thing here is to talk about is crossovers, right? So
Yes.
we can notice a crossover here.
So
And
crossover is when a shorter moving average crosses the longer moving average, right?
yeah,
Or vice
and
versa.
changing the trend.
Mhm.
So this could mean anything really, but it could also mean some bad news in some cases. So if we go back to some larger drop that happened, let me just set my chart so it's more visible. So if we're gonna go to the 221 drop that happened, we can see exactly what happened. So the 21-day moving average crossover the 8-1. It was a short-term trend in change. So this one lasted for, let's check, about 90 days. Sorry, let me just take a shorter period of time. I didn't get the cross on time. So yeah, it was around actually 90 days. It took 90 days for the trend to change and something to go upwards.
Yeah, and when we're talking about the crossover, the trend could change in either way. So it could pick up or it could continue to drop.
Yeah,
so
we could expect
no promises there.
Yeah, exactly. We can expect sideways movement and even upwards trending shortly before that, because we didn't have a crossover here and the price shot up. So these indicators are not used to predict the future price, because they're indicators from the past, and they're just allowing us to see what was happening and what are the support and resistance levels.
And that's also the point of indicators. We combine them to see what could happen and derive information from there. So we mentioned that we have simple moving averages, but we also have exponential moving averages. There's a difference because exponential moving averages are more susceptible to price changes, right? And
Yeah.
are therefore weighted. So the price change towards the end of the spectrum, so closer to the current price, has more weight to the overall average, right?
Yeah, so in layman terms, it's using a multiplier for giving more weight to the latest prices. Yeah.
So that means that it's more suitable for short-term trading, where the oscillation of market is more, I mean, it has more impact on your decisions, basically. As long-term traders or long-term holders, we don't really care about short-term market changes. So we are kind of deciding to put our trust into longer averages and long-term changes.
Yeah, this is why we're using also the simple moving averages.
Mm-hmm.
So yeah, again, just a brief history, we could see a lot of the times these crossovers happened there was a slight change in the trend dating back all the way to 218, which is the chart on my screen. But again, judging by what's happening right now, I wouldn't say this is nor bullish nor bearish, but we're waiting to see how this pans out.
Yeah, we'll see that in a couple of days. Maybe good idea for the next episode, as we revisited the NUPL and Fear and Greed index. We can also check what's going to happen with the moving averages and whether we're going to find that support level and bounce up or maybe even continue down. So we'll see what happens in the next episode. And another topic for the next one, as mentioned, we have loads of indicators. We're going to dive deeper into RSI and stochastic RSI. So sit tight for that one. And for everybody who's not so much into indicators, stick around. That's not going to be the only topic of the show. Long term, we will definitely branch into other topics, everything connected to Web 3.0. So definitely will be something interesting. Hope you got the hint.
That's nice. This is, after all, a show about technology and curiosity, and we're going to be trying to satisfy a broader spectrum of our listeners. And if you're watching this on YouTube, please leave a like, please subscribe, please leave a comment. We're excited to hear your feedback and to constantly improve.
And if you have a potential topic, a question, or just a suggestion, reach out via email to hi@casual.is. That's hi@casual.is. Thank you for joining us today. It was a blast. Hope you had fun, and we'll see you next time.
Thanks for the talk,
Cheers.
Ashko. Have fun, everyone. Bye.